Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, on this program over the last year or so, you would have heard a lot of experts, a lot of personal finance pundits come and tell you that asset allocation is crucial. Now, let's face it, when the equity market is roaring, we rarely give enough importance to that advice. But the last 6 odd months have taught us the importance of asset allocation. When you see equity struggling, you see your NAV is down in the equity funds, but you realize that gold has been shining, or even some debt funds could have been outperforming. So asset allocation is important. The question is, how do we do it in our portfolios? Well, joining me to answer this are Mohit Gang, who's, of course, founder and CEO at Moneyfront. And today I have also with me Ihab Dalwai, Senior Fund Manager at ICICI Prudential AMC. And Ihab manages ICICI Pru's multi-asset allocation fund, among others. Gentlemen, thank you very much for joining us on the show. So I'll open with you, and I'm sure today people will listen to both of you more carefully, because otherwise this asset allocation Gyan, as it's called, sometimes, in a roaring bull market, people don't want to pay too much attention. So, Mohit, opening thoughts with you.
Thank you so much, Surabhi. Always a pleasure to be on your show. Look, I think for ages, portfolio managers, asset managers, and we wealth managers have been crying hoarse that perhaps the best thing to do for a client is to have good balance between equity, fixed income, commodities, and maybe a few other assets depending on the profile, right? It's oft ignored, as you rightly said, because of the market movements. Once you get carried off in a market frenzy, then you typically tend to ignore the basic fundamental principles, the 101 of finance. But if you watch the data for last 6 months, 1 year carefully, and maybe even on a longer time frame, you'll realize that if an investor had a proper mix, a proper dilution between equities, debt funds, commodity funds, which is gold and silver, the returns would have been far, far superior. The moot point here is risk-adjusted return. So for a lesser unit of risk, or for a much balanced unit of risk, you get perhaps higher returns, or you get almost equivalent returns from just holding a pure play equity portfolio. So were you in 100% equity versus you were in a 60-40, 65-35, or a debt equity portfolio, or a 50-30-20 equity, debt, commodities kind of a portfolio, your returns would have been much superior in last 6 months to last 1 year. And risk adjusted, you would have slept very, very peacefully.
Oh, absolutely. And I think we'll just pull up some of the data points there. If we can drop the comparison of asset classes per se, the Nifty 50 has obviously corrected. The Nifty 100 has corrected even more. But the reason we've picked up some of those other funds is just to give you a flavor or an indication of how other asset classes have done. That's the Crystal Hybrid Fund, which has a mix of 35-65 equity and debt. And as we can see, on a 6-month basis, it's fallen less than equities. On a 1-year basis, also it's an outperformer. And if you look at gold and silver, Edelweiss is just an example. We picked up one AMC as an example, but because of the way precious metals have rallied, look at the returns for that fund: 31% versus 1% on the Nifty. So they say the market is the best teacher, and the market has definitely taught us that lesson in the last 1 year. Ihab, come in on this. But, if I could argue from the investor side, sometimes it's also confusing, because all you folk also say that when we are young, when we are earning, especially young investors, they should load up on equity in a big way. And maybe that's another reason why people tend to ignore. When you're young, you don't want to think fixed income or debt or too much diversification. So how would you approach it?
Yeah. So, see, basically, it's important to understand how these asset classes have performed over a long-term period. And if you look at last 10 years data as well, so debt has come out as a winner 2 out of 10 times. Equity has come out as a winner 3 out of 4 times, 4 times out of 10 times. And similarly, gold as an asset class has come out as a winner. So it is important for us to understand that each of these asset classes perform differently in the different phases of the market. So for us, it's important to understand what is the outlook for each of these asset classes and how we should allocate them in a balanced portfolio. So obviously, over a long-term period, equity tends to do well versus most of the other asset classes. But when equities tend to do well, it is to some extent important to do some profit booking and shift to the other asset classes, because there have been historical precedents that these asset classes also do well versus equity.
And now I guess, Mohit, the numbers are telling us that story,
Absolutely.
right? The equity has been struggling, but gold completely shot up. So, okay, fine. Point taken. We need to have diversification and separate asset classes in our portfolio. Now, where do we begin? I mean, there is the simple get a hybrid fund approach. There's also maybe I'll do my own equity funds. I'll add my own debt funds. What would you advocate?
Surabhi, I think it totally depends on the profile of the investor. If you are an investor who's kind of involved in your portfolio, who understands the nuances of the markets a little bit, who understands the different kind of asset classes, what does each asset class entail in terms of risk and rewards, right? Then perhaps the better approach is to determine your asset allocation yourself or by sitting alongside a financial advisor, right? So there you can decide whether a 50% equity composition or a 65% equity composition is good for you, and simultaneously also decide what kind of debt and commodities composition you want. And depending on what your objective, financial goals, risk profile, other things are, you kind of allocate assets accordingly into pure play categories, which means a pure play equity allocation, a pure play fixed income allocation, and a pure commodities allocation, which could be a debt, which could be a combination of gold and silver or whatever, right? So that's, to my mind, the best and the right approach, which also requires one to be being involved in the portfolio. If you're a little hands-off investor, you don't want to get into the nitty-gritties of asset allocation yourself, don't want to study so much, don't want to determine the right choice, right mix, and the reshuffling between these, which is the most critical part, which is often ignored, and often the retail investors can't do that, is the reshuffling between these three asset classes. Then perhaps you say, okay, I am just putting my hands up and I'm giving it to better money managers and fund managers and professional advisors, and then taking cushion in hybrid funds, in balance advantage funds, in multi-asset funds, which will give you the best of all the worlds. And perhaps the good part is managed by professional fund managers and systematically managed with discipline and with proper research, good allocation mixes, and which keeps changing timely, right? So you get best of everything, and you can just, again, as I said, just be peaceful.
Absolutely. Leave it to the experts, so to speak.
Absolutely.
Ihab, what would you say? Because as an asset manager, you offer both options. Someone can come and individually pick debt funds that iPru offers along with equity funds, or maybe even, a gold fund. Or you can go for some of these composite products, for instance, balanced advantage funds or a multi-asset fund. Personally, what approach do you think is right for a retail investor?
So generally, if an investor is a bit confused in which asset class one has to invest in, I think the easy way out is to just invest lump sum in these hybrid schemes, because ultimately, like Mohit suggested, was that it is for us to determine what allocation we have to do for each of these asset classes. And it's important to understand that these asset classes will perform differently in different phases of the market, like I mentioned earlier. So I would still suggest that hybrid schemes is a better way of doing it, because an individual will find it a bit difficult to determine which asset class is expected to do well in the near term. So I think it's best left to the professionals to determine that. And one more point I wanted to highlight was that it's more cost efficient for an individual to do it through the hybrid schemes versus to do it at an individual level, because the reallocation or the calibration which we would be doing across these asset classes, I think it's more cost efficient in the hybrid scheme versus doing it at an individual level.
Oh, fair enough, yeah, because every time you are selling and moving some money to a different asset class, you'll have to deal with the capital gains tax, whether you're shifting from debt to equity or equity to debt. Got that point. Point well taken. So hybrids are the way to go. But now hybrids as a universe is a fairly complex universe, Mohit. I mean, it's not an easy, world out there. Absolutely. I might argue that it's even more difficult than picking a, mid cap or a small cap, where the definitions are absolutely watertight. So within hybrids, just revise the universe for us, what our options are, and then what should be the first parameter? When I'm thinking of, getting into a hybrid fund, what's the first filter that I should apply?
It's a massive category. It's a quagmire of funds out there. You have hybrid, you have balanced advantage, you have dynamic asset allocation, and you have multi-asset, right? I hope I've not missed anything, but yeah, to my mind, I think those are four broad-based categories. The first things which an investor needs to know is what allocation does he want in equity and debt. What is the kind of allocation he's looking for? What are his long-term objectives? What are his long-term financial goals? And how much risk is he willing to take? So he has to be very comfortable as to, let's say if I'm investing for 1 or 2 years or I'm investing for 5, 7 years. That's number one. Whether I'm okay to go with a slightly aggressive tilt within the asset allocation model itself, or I'm wanting to keep it low profile, conservative, very less equity oriented kind of a thing, right? So you need to answer these 2 or 3 questions, basis which you will determine what kind of allocation do you want. So I could be an investor. I say no, at every point in time, I need to have a fixed allocation between equity and debt, and that allocation will be more in favor of debt. So then I go for a conservative hybrid fund, where the allocation is broadly streamlined, that equity won't cross 25% and the remaining portion will be debt.
That's a conservative hybrid fund.
That's a conservative hybrid fund. Then you have a moderate hybrid fund and you have an aggressive hybrid fund. But the allocations between equity and debt are fairly stable. It doesn't change too highly or rapidly. But I'm an investor who say I want to also make use of market movements. I want to shift between equity and debt and let the fund manager take that liberty to move the allocations. Then I'll perhaps go for a balanced advantage.
Which is dynamic asset allocation.
Which is dynamic asset allocation, where the fund manager, now each fund manager will have their own criteria. I think for Pru ICICI, perhaps it could be a price to earnings and price to book value kind of a model, which they follow in Pru Balanced Advantage Fund. And where they will dynamically determine as to what portion of money has to be kept in equity and what portion in debt. And they will keep shifting between the allocations. So if the markets go up frantically, they will reduce equity and increase debt. If the markets are falling, which is the current scenario, they might perhaps be increasing equity allocations in their portfolio and reducing debt, right, to make use of the market movement. So that's been a time-tested, proven methodology. There could be a third approach where an investor says, I want the best of all worlds, not just equity and debt. I want a flavor of commodities. Maybe I want a little international. I want REITs and InvITs in my portfolio. Then perhaps the best way, which is to go as a multi-asset fund, where you will have equity, you will have debt, you will have commodities to the tune of around minimum 10%, which can go up to 20-25%. Some portion of REITs, InvITs. Sometimes some funds do take international investing also as an option. But it gives you a comprehensive world of investing just packed in one single fund.
So again, so lots of options. You need to know what you want.
Absolutely.
What is it that you're after, and more importantly, how much risk can you stomach? Ihab, on this very point, and we'll go through these individual categories specifically. But you know, overall, let's get the low risk investor out of the way first. Anyone who's low risk, who's not getting into a hybrid fund for high returns. Maybe you know, he or she is retired, or maybe just generally they don't want too much risk. Then what is the category of hybrids? What type of hybrid funds would be suitable for them?
So like Mohit also mentioned, for me as well, I think the risk grading is such that BAF or MAF, and the first is obviously ESF, like you said, it is a lower end of, in terms of risk profiling, it is on the lower side. But if someone wants to take some slightly more risk and is looking at hybrid as a strategy, BAF, MAF, aggressive hybrid, and also there is an asset allocation fund through a fund of fund route also is something one can consider. But my preferred choices have always been a dynamically managed asset allocation, because I feel that, like I mentioned at the start, is that each of these asset classes perform differently, are volatile. So if you have a dynamic model, back-tested model, which has succeeded over a period of time, you can gain out of the volatility and try to generate returns or alpha through the volatility. So my preference would be a dynamically managed fund, maybe a balanced advantage fund or a multi-asset fund.
Okay, so multi-asset or balanced advantage. Got that. That is Ihab's pick. We'll take a break, but we dive a little deeper. Now we've understood that BAFs, as they are called, balanced advantage funds, or MAFs, as they're called, multi-asset funds, they're good funds and they can help you across multiple asset classes. But how do you pick one fund in these categories? Back with that in just a bit.
Let's talk money